Hi, everyone. I'm Maggie McGrath, senior editor at Forbes. Fed Chair Jerome Powell addressed the House and the Senate this week, and his comments touched on everything from inflation rates and interest rates and the Consumer Financial Protection Bureau to cryptocurrency. Joining us now to talk about it all is Steve Forbes. Steve, thank you so much for being here.
Good to be with you, Maggie. Thank you.
So, Fed Chair Jerome Powell touched on a lot of subjects. Can you just give a brief overview of what stood out the most to you in his testimonies this week?
What stood out the most, and certainly got the president's attention, was no cuts in interest rates. They think they have inflation under control, and I think what has happened recently in terms of the inflation numbers that came out this week is reinforcing the Fed's decision to stand down and do nothing. And what this gets to, though, is, even though people focused on that, is the whole model of the Federal Reserve. What's going to be coming up in the months ahead, and investors should be prepared for it, is there's going to be a big fight between the White House and the Federal Reserve. Not about the Fed's independence, not even the particulars of interest rates, but the whole way the Fed operates. The Fed has this belief, shared by other central bankers, that prosperity causes inflation. And so therefore they try to manipulate the economy, either stimulate it or hurt it, slow it down, impede it, because they think that's the way you control inflation. They forget there are two kinds of inflation. One is what you might call non-monetary. So like you have bird flu, that's going to raise the prices of eggs. Interest rates are not going to affect how many eggs hens lay or how many hens are around. So they can't control non-monetary inflation. What they can control is monetary inflation, traditional kind, which the definition is lowering the value of your currency, usually by creating too much of it. And so the Fed, but no one at the Fed, no one at any other central bank around the world talks about stability of currencies. They all focus on the economy. Do we goose it? Do we impede it? It's a fundamental flaw. It's called the Phillips curve, derives from something called the Phillips curve. It's not a baseball pitch. It's named after an economist who posited back in the 50s and 60s that there's a trade-off between inflation and unemployment. If you want lower unemployment, you have to have higher inflation. If you want lower inflation, you have to have higher unemployment. Well, today the Fed has been in a muddle because you've had low unemployment, and until recently you had high inflation. That was not supposed to happen. And it shows the Fed's view of the world is wrong. So the Fed should be focusing on a stable value for the dollar. And this is where the Fed is looking at the wrong numbers. Right now, two good barometers of trouble for future inflation, i.e. the value of the currency, is general commodity prices. Everyone focuses on oil, but if you look at the general indexes, they've been soaring up over 20%. The gold price, very good long-term barometer of inflation signals. That has gone up enormously, approaching nearly $3,000 an ounce. That should tell the Fed the dollar is weak, even though we're doing better than other currencies. Right now we have a situation in the world of junk currencies. None of them is really stable. The dollar's better than the others. But talk about baseball coming up, it's like having a 200 hitter leading the league. It's pretty poor.
So what do you wish you had heard from the Fed chairman in this testimony this week?
I knew it wasn't going to happen, but I wish the Fed chairman had said, Jerome Powell had said, in the future we're going to focus on a stable value for the dollar, get stability for the dollar and hopefully then other currencies. And we're not going to try to stimulate or impede economic activity. If you step back and think of it, it's amazing in a democracy, free enterprise system, that we'd have a group of people in Washington trying to determine the level of economic activity. And that's why we get this talk of if times are good, the Fed starts to talk about, oh, is the economy overheating? Now think of how absurd that is. If you get a pay raise, do you start sweating at night? Oh, I'm overheating? Take it away. No, it's preposterous. The economy's not a machine. But that's the way they think. So they either try to stimulate or hurt economic activity. And I wish they'd move away from that model, but it's going to take a fight with the Fed to change that whole way of looking at the world. So in the meantime, the Fed is stoking inflation without even knowing it.
Now, Steve, you mentioned
That's the headline. They're stoking
inflation without even knowing it. Okay, there's our headline. I want to drill down into something that you said about commodities prices and gold prices. It's similar to something that President Trump said at Davos, which was oil prices are coming down, so interest rates should come down. And the Fed Chairman Powell said this week that we do not need to be in a hurry to adjust our policy stance. So what do you make of the disagreement between the president and the Fed chair?
Well, the president wants lower interest rates because he thinks that's going to stimulate the economy. And he thinks that we're going to get lower energy prices as we bring in the months ahead, open up more and more fields, start rebuilding infrastructure and energy, start getting some LNG exporting facilities up and running. That takes time. But you just can't look at the oil price. You got to look at all general commodities. Oil is in a situation where we have a world economy that's not doing very well, so demand is not very vigorous. And and the idea that you control the economy by manipulating interest rates is something that is bogus. They're using the wrong instrument. If you want to have a stable value for the dollar, you make sure you're not printing too much money. And so if commodity prices overall are stable and the gold price is flat, okay, that's fine. If they're going down, that means you're too tight. If they're going up a lot, that means you're too loose. So the market signals are there, but they ignore them. Not always. In the past, when Alan Greenspan ran the Fed for a while in the 1990s, he followed gold. He said so publicly. He followed commodity prices. And it worked. For some reason, he moved away from it in the early 2000s. But so follow the market signals. And so in terms of, I think President Trump knows something's not right and is trying to get his arms around it. But you can't just look at the Fed and manipulating interest rates. It's a trap.
President Trump has indicated that he thinks he knows more about interest rates than Chairman Powell. Do you agree with that?
I think he knows more about what makes an economy work and what fuels inflation than Chairman Powell does. The Fed, remarkably, has been wrong on inflation time and time again. Even before COVID, if you looked at market signals, the dollar was starting to be under pressure. They grossly underestimated, talk about non-monetary inflation, the impact of the lockdowns and how when you disrupt the sophisticated, ultra detailed supply chains you have today and you have one thing that doesn't work, discombobulates everything. They totally underestimated that. And so that sent up prices. And so in terms of interest rates, I think Powell needs to have some remedial education, but he's not alone. The whole central bank world has this idea the economy controls inflation. No, you control inflation by how much money you create or not create.
Now, Powell's term is scheduled to end in 2026, more than a year from now. Could President Trump remove him?
The answer is yes. The Fed is not a fourth branch of government, even though it would like us to believe it. It's a creature of Congress. And if you have a battle between the Fed chairman and the president will ultimately win. Classic example is in the late 40s and early 50s when the White House got in a fight with the Fed on interest rates. The Fed eventually got to control interest rates, but the chairman of the Fed was ousted and a new one was brought in. So in the real world, the president will win. Moreover, in a peculiarity of the U.S., dollar policy is actually lodged in the Treasury Department, not in the Fed. So if the president and the Treasury Secretary determine Powell must go, his position will be untenable, and they'll have to have a new accord. They had a peace treaty in 1951, the Treasury Accord. They'll have to have another one, but he could. But there may be a situation where he doesn't want to commit the political capital, but start the debate. How has this institution operated? What are their assumptions? Why has their record been so poor over the years? And that lays the groundwork for a new head to come in early 2026 who will change the way the Fed operates.
Now, at the top of the conversation, I mentioned that Powell addressed not just interest rates, but also the future of the Consumer Financial Protection Bureau and cryptocurrency. On these other topics, did anything stand out to you?
Well, I think the whole Consumer Bureau is very interesting. Protection Bureau, Consumer Financial Protection Bureau. I love how they come up with these mouthful of words. But anyway, it was funded in, I think, a peculiar and unconstitutional way. And that is, instead of getting an annual appropriation from Congress, as every other government agency does, it's funded by the Fed. So the Fed earns interest on the bonds it holds. Until recently, it always had a surplus, which it turned over to the Treasury. At one point, it was turning over $100 billion a year to the Treasury Department. In this case, they did an end run against Congress and had the Fed directly send the cash over to the Bureau. And so there's no traditional accountability. Now, the Fed, as only a central bank in modern times could do, is losing money. It is operating in the red because during the quantitative easing, they so lowered long-term interest rates and bought so many. At one point, the Fed had over $9 trillion on its balance sheet, whereas before the crisis of 2008, 2009, it was only $800 billion. So at one point, there was now about $7 trillion, but 10 times what it was traditionally in the past. But those bonds and mortgages were 1%, 2%, 3%. Well, the Fed also decided years ago to pay interest on bank reserves. Banks take their cash and deposit at the Fed every day. And so they paid interest on those bank deposits. Well, when interest rates went up, guess what? Short rates were 4 or 5%. The Fed was earning 1 or 2 or 3% on its bonds, and so it is losing money. So the challenge is that, okay, you're losing money, therefore you don't have a surplus to finance this Consumer Bureau. Therefore, we can get rid of it we can defund it because you don't have the cash there. And so that's going to be a big battle. And as for cryptos, they're going to still be wondering what this is all about. But the key thing there is making sure the central bank doesn't issue a cryptocurrency, a crypto dollar, because then they'd know everything you spend your money on. They'd have a record.
It sounds a little bit like too much surveillance, perhaps.
Yes.
On the Consumer Financial Protection Bureau, we've heard from Democrats that the agency has saved American consumers something like $20 billion since it was created, and has served as a watchdog and a source on information on student loans and overdraft fees. If it is dismantled, where does that oversight go? Does it go to the states, in your opinion?
No, it goes to various regulatory agencies and law enforcement agencies, just as it was before. It wasn't as if nothing was being done about financial fraud until this thing was created 10 or 12 years ago. So it goes back to what it was before. So, yeah, wrongdoing. You got the SEC, you got various bank regulators on the federal and local state level. You have law enforcement, so if skullduggery is going on, you ferret and root it out. So it's not as if it's Wild West time. It was an agency created at the behest of a senator, Senator Warren. They brought in various orders and rules from other agencies and brought them all together. Well, you undo them again. And because they didn't have that accountability to Congress each year, they went and did things that were not based on fact. They went after auto dealers financing, and turns out it was fact-free. The courts have overruled them several times. So as an agency looking for a mission and creating more trouble than doing good. So, yeah, the surveillance will be there. It's just we'll have one less bureaucracy involved.
Now, at the top of the conversation, you said investors will have to watch the debate around the structure of the Fed. And I was intending to ask you what you think the market's reaction to Powell's comments will be in the near and medium term. But if you're speaking to Wall Street, if you're speaking to investors, what's your message for how the next 1 to 3 months could unfold?
Well, right now, everyone is saying, oh, status quo, it's expected, no big deal. You saw that in the reaction in the marketplace. But I think what investors should look at is when it becomes apparent that the inflation has not been totally conquered as they measure it, which is a whole other subject. I think investors are going to see fireworks. And initially, the markets are going to be upset because it's going to be portrayed as inflation-happy White House versus the guardians at the Federal Reserve. And it's going to take a while for people to fully realize, no, it's about the real model of the Federal Reserve. And so I hope officials, and I think you should have conferences and seminars and all of that, how should the Fed operate? What should it be its operating model? So you set a basis of what the real debate's going to be about. How should the Fed operate?
How should the Fed operate? The big question in 2025, according to Steve Forbes. Steve, thank you so much for joining us.
Thank you, Maggie. Good to be with you.